we could be looking at a fresh or a renewed set of momentum.
Sameer Dalal joins us now. Sameer, hi, morning. We just completed the earnings season. What's your takeaway, especially with respect to some of the consumption stocks?
Yeah, so good morning. Thank you for inviting me. Results for the consumption stocks have actually been better than my expectation, I'll be very honest. We thought there might be a bit of a demand slowdown given the fact that commodity prices had moved up, which would lead to some amount of demand reduction with that. But surprisingly, it's the consumption story has been extremely resilient across the board, barring maybe one or two companies that have shown muted growth though also I will say they've shown muted growth, not degrowth, right? So from that angle, we think that is a great positive. Now, the hope remains that this matter in the Middle East resolves sooner rather than later, so that crude prices come off and eventually all the products that are linked to that price escalation, some amount of price increases that have happened can get even rolled back. So if all of those happens, we think the consumption story is very much on a strong wicket and good to go. So stocks are showing that. If you look at it, the QSR space has bounced back very nicely. If you look at it, some of the other retail spaces are doing quite decently. They've moved up. Trend gave a good set of numbers, but the stock has corrected. Vishal Mega Mart's doing all right. B2 Retail's doing all right. So from all of those angles, I mean, it's been quite good.
Okay. I wonder how you're looking at Samman Capital's numbers, Sameer. I know you track this one closely.
Yeah, I do. So you know what? Given the fact that they had taken such a huge write-off in the last quarter, we were expecting there to be write-backs. And if you look at it, they had a provision write-back of about 240 crores, right? Which more or less is what the profit is. Now, the growth has been decent. They did a 3,800 crore disbursements in the quarter. They're diversifying their books, so about 800 crores was for the prime housing, 2,000 crores was for LAP, builder loans and things like that. And then they've moved to a loan against shares. I mean, that's an early start. And from next quarter onwards, you'll see some amount of gold loans and all of that coming in. So disbursements were good, but still we see a sizable increase in their loan book. Because you look at the end of the day, when you took as big of a write-off as they did in the last quarter, till they collect some of that money and they increase their overall assets, their OPEX is going to remain optically high. And the management has guided for about, Gagan Manga yesterday talked about the fact that he'll achieve his numbers of 10,000 crore disbursement. So if all of those remain on track, I'm sure the company prospects will look better. But like I said, for one quarter, the numbers of just 240 crore profit, it's okay, but more or less from the write-backs that have come from the provisions that they made in the last quarter. We want to see further profitability coming from operations. They've got a ratings upgrade already one round. They're hopeful for a second round of upgrade. They're talking of the fact that their international bonds are trading at a higher price than the issue price. So that means the yields have moved down. So fresh funding that will be borrowed overseas will also be at better cost. So if all of these things plan out over the next, say, 1 year, you will see the stock moving higher from here because it's trading at pretty much book value. So you have nothing to lose with a zero NPA kind of a story. This is something that's right for the taking.
Okay. And Sameer, Tata Motors, how are you looking at those numbers come through?
So, for the India operations, I think they did fantastic, right? 17,000 crore turnover. The electric vehicle business grew 112%. I think it was the Jaguar Land Rover where there was a bit of a degrowth of 9%. And because of the degrowth, the operating leverage obviously works in a negative way, right? So when you sell less and your cost remains the same at the broader level. So you saw EBIT margins coming off by 120 basis points in the GLR, which is where the profitability has actually declined. The bigger problem, though, which is something which came, I mean, I'd not say it's a problem, but something that worries me a little bit is the cash flow of the company. I mean, at Jaguar Land Rover, they had about what, a billion pounds worth of negative free cash flow, which is a cause of worry because of which the overall borrowing structure is now at 42,000 crores. I'm not denying the fact that they have cash reserves against it, but the fact remains that cash flows have been hit a little bit, and this is something that the markets really should focus on, cash flow, right? So the management obviously is guiding that this will all reverse, this is temporary in nature, and we also believe that that could be the case, but we want to see that cash flow number changing quite quickly. But overall, if you look at it, 4 new launches that they've talked about, 3 in the electric vehicles in Jaguar Land Rover, the Range Rover, I mean, I forget the names of it, but the Range Rover Electric, I think the Range Rover Discovery Electric, and the Jaguar Type 1 is being launched. Now, these are exciting launches, and once that happens, and if Jaguar Land Rover can get some of its mojo back, I think the stock is again something that will do really well. Like I said, the India ops continues to go from strength to strength. They've scaled up really well. They've turned EBITDA positive, EBIT positive. They had cost increases this quarter. So as they pass on that and, the stabilization of the costs happen and the gross margin, I think the Indian ops will keep adding on to the profitability, but we really need that turnaround in Jaguar Land Rover. And that is constantly getting pushed back. The only advantage that they have is that last year's base is so dismally low from profitability from all the quarters because of the problems that they had. They can only do better. And given that they can only do better, and if I project for FY28 now, not only FY27, but for FY28, and we believe the new launches will start doing well, I think the downside risk for Tata Motors PV is quite low, and in fact, the upside is quite strong. So I would actually go out and make an investment at this point of time. And I've been bullish on it for quite some time.
I want to quickly clarify on Supria. Suggested that the numbers were weaker, but there is an adjustment to be made to the numbers. The management, and I'm told by our research team, Sasha has pulled this out. She says that the management noted that a batch of export materials intercepted at customs on the 30th of June was recognized as Q1 revenue, but excluded from closing inventory, which has skewed the cost revenue alignment, which is why you've seen those costs jump up by 70-80% versus the revenue going up by 30%, which is what is called which is what has caused the precipitous fall in margins. Of course, we'll still wait and watch for the reaction, but essentially this is an adjustment which will likely unwind in Q2 or Q3 at some point of time this year, which will mean that the margins at that point will be higher, and therefore the full year will likely not be impacted. Of course, we'll have to wait and watch for commentary coming through, but broadly this is the take, and that's why you want to quickly mark that as well. But I wonder, Sameer, how you're looking at Jubi's numbers, at Hunasa's numbers. I mean, Jubilant using now Popeyes to kind of accelerate growth, right? Ensure that momentum remains. It's impressive, 40% like for like on the smaller base, but nonetheless.
Yeah, so, that was one category I guess they were missing out on, which was the burgers and chicken side. The pizza side, they dominate the market. Jubilant has over 2,000 touch points in India, which is fantastic. I don't think anyone else comes close to them when it comes to the pizza or any other category for that matter, right? So now with the Popeyes coming in and them expanding that, it's still early days. They've only got 54 or 55 outlets of Popeye. There's huge opportunity to scale that up. And if anything we've seen from this group is that they are really good at increasing the scale up really quickly. Now, what I liked about Jubilant, we can always talk about the Popeye side of the business, which is showing decent growth, but that's a very small that's a very small contributor to the overall profitability, right? I would focus more on the pizza side of the business. And what the management very clearly indicated during the interaction yesterday was that they are now not going to be making fresh investments in the back end, and more of the investment and more of the openings is all going to start happening at the front end. So they're going to be able to sweat out those assets a lot better, which means the operating leverages can kick in not from two angles. I mean, one angle, which is LFL growth, because when you have LFL growth, obviously the OPEX of the store level increases, but you're going to get operating leverage coming even from the back end. So given the fact that we believe the consumption story is expected to remain strong, given their distribution reach, even a small uptick in demand in the pizza space that could happen could re-rate the stock. And if you look at it, Jubilant FoodWorks is corrected from, I think, what, a high of maybe 1,000 plus over the last 2-3 years, right? And it's come down all the way to trading at below 500, sub 500. It's rallied a bit recently, but it's still from the peaks, it's really higher. So if the operating leverages play out, which we just discussed, the two of them, I think this is something that could see a massive spike up over the next year or so. We've been constantly saying QSR is a space that is looking attractive from the consumption story. I mean, we talked about Westlife with you all also, if you remember, that they have only 540 odd stores in India. Imagine McDonald's as in the country of India in the south and west, which is Westlife, only 540 stores. The opportunity to go to 2,000 stores in just that region is so strong. So for us, this is a space that should do well. Jubilant numbers were good. We remain constructive and positive on that. Onasa, actually, I haven't seen the numbers, so I don't want to comment on them. So, Aisha, there are two ways of playing that, right? One is you play the B2B players who cater to some of these brands, right? Which could be your Dixon Techs, or which could be your Ambers and PG Electropass and those. And then you have the actual player like an LG. I mean, then there's one other, I think, Onida that's listed, Merck, which is listed. There are not too many other players in this who are the direct brands that are listed at this point of time. So LG probably becomes one of the ways to play it. But if you don't want to take a risk on one particular company, and I'll tell you why I'm not very bullish on LG, is the fact that this is a very competitive space. Small change in the discounting and the hurts the margins quite significantly for them. Can hurt, and we believe, given the high competitive nature of this business, it's not going to be easy for them to keep increasing their profit. I mean, they may want to say that we'll be able to do it, but we when you go to the store and you can see the kind of discounting models that are working, and that obviously opens up a bit of risk. So it's not only the home entertainment, but also the washing machines, the fridges, all of that, right, that they cater to. And there we do see a very high competitive space. So at this point of time, LG for us is an avoid. Results were decent. I saw the numbers. Nothing to take home, nothing to get excited about, nothing to get very disappointed about, pretty much in line. But another way, if you want to play it, unfortunately, the stock has run up a little bit recently, is, to play the guys who put the storefront up for all of these electronic players. Like EMIL is one of the listed players. Of course, you have some of the others like Chroma, and you have Reliance Digital, but Reliance Digital you can only buy. It's a very small component of the entire Reliance Industries. So that becomes a way to play it. But EMIL, that is Electronic Smart India Limited, has run up quite a bit from 100 to 180, I think, in the recent past. So that could be something that one could look at in correction, because at the end of the day, they cater to all brands, they cater to all products, varying from phones to TVs to fridges to under their brands of Bajaj or their independent stores. And we think that is something that could do really well over a longer term period as consumption picks up.
Samir,
Interesting. Sameer, stay with us. We're going to take a very quick break and come right back to you.
do you sum up the earnings? Is it coming as per expectation, or it's a little better in terms of top line growth, but margins are a little compressed?
So very rightfully so, right? When you have commodity spike, inflation, metal prices going up, derivatives of crude prices moving up, you're going to have price pass-ons, right? And that is going to lead to revenue jumps. But EBITDA may not jump, and EBITDA margins look smaller. So if you, for example, I'm just giving my thought process here. If you're selling something for 100 rupees and you're making 10 rupees on it, but you get inflation of 10 rupees. So now you sell for 110, but you're still making 10 rupees on that product. Your margins look smaller, right? But you're still making the same amount of money. which is the kind of situation we have been facing for the last, I will say, 6 months, well, less than 6 months, about 5, 6 months since the war began because of certain price rises that have happened. And that is why what we are seeing is the top lines are growing, but the EBITDA is not, which is pretty much what we kind of expected. The, the beauty of this is if the prices of these commodities start coming off, which we are very hopeful for, which we've been saying that, at some point in the next like 15 days to a month, this situation should end and all these prices should start coming off. Supply should start picking up because the shipping routes will get better. I mean, will open up, which will allow freer trade, which will allow things to come in at better timings are better, availability will improve. And all of that happens if some of this price hike that has been happened is allowed to be captured by the seller when the price cuts happen, then you will see profitability actually starting to move up. And then when you get that growth in profitability, then your valuation multiples will not look as expensive. So yes, earnings are pretty much in line. We remain more positive rather than negative now on the things given what we have seen in Q1. Now, of course, if this war escalates, all bets get called off. If crude moves above 100 and 110, then all bets get called off. But we don't see that situation arising, especially given the fact we're getting closer and closer to the US midterm. And the president of the United States is going to look for an exit because he doesn't want to go into the midterm elections with leaving a situation where inflation is high, the war still hangs around. And if something like that continues, then he loses. He has the risk of losing the Senate, and if that happens, he could even get impeached. So things like this happening, we think it's going to be sooner rather than later, and we remain positive and constructive.
Sameer, one stock which was a darling of the market few years back, now it's very muted. Page Industries. The volume growth has been very tepid. They've not been able to get back that high growth in this segment.
Yeah, so Page Industries got a lot of growth also because they kept expanding not only their reach but also their product profile, right? So they did double expansion. One, they were expanding where they sold the branches, their MBOs, the EBOs, all of that. But then they got into leisure wear, nightwear, from being a pure undergarments kind of player. So when you expanded your broader product profile, your growth was getting a lot better. Now there's a bit of saturation that is playing in, right? So from that angle, growth may start looking a little tepid. But then again, this is again a great play on the consumption story. If we believe that the Indian economy, the consumer is going to come back and consume a lot more over the next, say, year and a half, given the operating leverages that they have, not only at MBO sites, but the EBOs, where they have set up these great stores. So they're making products from sportswear to nightwear to socks to underwears, vests. Now, just simple t-shirts. So all of that, if that demand starts picking up, that will do well. The problem is that this stock has captured a lot of the upside valuation because if you look at it, it's been historically, it's always traded above 50, 55 times forward earnings, and that doesn't change even after, the stock has seen a consolidation, I think for probably 2 years now. It still trades at expensive valuation. So the real story will be is if they can get that SSSG or like for like, whichever way you want to call it, the growth going at their end. If that kicks through, then there is upside. Otherwise, I think the stock will remain in a limbo. And if you look at it, companies that traded at high valuation and didn't get the growth playing through, like a Lever or like a ITC or many of these other players, the stocks have given no returns for 4 years, 5 years. In fact, if you look at Lever's returns for the last 8 years, I think the CAGR returns is about 4.5%. So what stops Page Industries from going through a situation of poor returns over a longer term period if they're not able to? So even though we think there's great business, we think valuations are a bit high, and this risk always remains when you buy any quality or good asset also at an extremely high valuation. your returns become muted over a longer term period. And that risk still remains with Page even buying at these valuations.
Okay. All right. Sameer, I wonder from the paint space, the kind of numbers that we've got this time around, Q1, they've been quite resilient, right? I mean, Indigo Paints came out with a good set of numbers today as well. What do you make of the entire sector and the competition coming in?
Yeah, so, I'm surprised that everyone claims to have captured more market share, right? If you hear the JSW call, we've got more market. You look at the Grasim call we sat for, Birla Opus says we are now at 14% and we've captured market share. Asian Paint says we are growing, we are capturing more. Indigo says we are capturing market share. So I guess the unorganized space was quite large and that is reducing kind of in nature, which works out quite well if things move more to the organized space. But you got to remember that, look, when there is so much competition, you have Birla Opus that has put in 5 factories which want to scale up their ops, get their factories running at much higher levels. They're going to be pushing more aggressively. There always remains a risk of pricing pressures not being in favor. Surprisingly, all of them have done really well over the last quarter. So, I mean, difficult to say that they will not continue to do well, given the fact that the market will keep increasing. All of them put up this beautiful chart that the per GDP spend on the paint industry in India is significantly lower than the rest of the world. So, the scale up of the demand that could come through over the next many years is great. And we believe that story. We also think that there's great opportunity. People probably don't paint their houses in India for 15 years. Maybe that could change to 10 years, maybe 7 years, upgrading, all of those things happening. But we need to see that playing out in the numbers. We need to think this is more of a longer term thing. And second, again, what I just discussed with Page Industries valuations. So what had happened in the past with all of these paint companies is the valuations. Asian Paints was the the other paint companies which are there from Calcutta, I forget the name at this point. Berger Paints, that's the one. All of them were trading at very high valuations, and that has again corrected, right? Now the question is, when we look at it on a PEG basis, the bases have all become bigger. Indigo is still smaller in nature, but for Asian Paints, Berger, they've all become sizable players. So when you're sizable and your growth starts slowing down a little bit, and then you have to reduce the PEG ratio or maintain the PEG ratio at 2, and your growth has suddenly gone from 30% to maybe 15% or 18%, your PE multiples also start contracting. And that is what is happening across the space in the paint industry as well. I wouldn't be surprised if you get good growth, but stock prices don't move for a little bit longer. And we've already seen that. So I think that trend will continue for 1 year more. And if the paint industry is able to show that even with this high competition, they're able to grow, then I think they will probably start moving up with a re-rating bias on the positive side. So we need to see that. For the next 6 months, I think still caution. But if things start looking positive, I would look at Asian Paints as a player, because they're not only in paints, but they're in the home decor space. With that space is also doing quite well. And as they expand that, that could be something that's interesting, not only from the paint angle, but from the home decor angle, the other businesses, if you look at these smaller parts of the businesses, as they scale up.
Yeah, absolutely. But Sameer, great to have you today on the show as always. Thanks for joining in.
Thank you very much.